Hello, welcome back everybody. Now sadly Jurek can't be with us because of some flight issues, but the show must go on and we're very grateful to Sarah McGinty for stepping in, so thank you Sarah. So this next panel is Global Asset-Backed Finance, and I'm going to pass over to Sarah now to start us off. Thank you.
Sarah McGinty from Ares. I head up capital markets at Ares, and I am a sub-in as of 5 minutes ago. So everyone, just bear with. This is the true definition of winging it. So welcome to the Asset-Based Finance panel, the next frontier of private credit. And I think we'll take the opportunity for everyone to introduce themselves, and then we'll get going with our panel.
Congrats everyone for sticking around on Thursday. First time we're doing a private credit event on Thursday. I think this is my first attendance on Thursday. So my name is Eli Applebaum, and as it says somewhere up there, I run the alternative credit business in Europe for Ares. And we cover the entire spectrum of asset-backed investing, anywhere from investment grade all the way through equity. So we have a broad mandate. We're excited to share how we're spending our time in the market.
Hi everyone. To echo Eli's comments there, I was expecting there to be more people on the panel than the audience on a Thursday of Global ABS, but good turnout. Rob Sinclair, Managing Director for AB Carval. For those of you who don't know us, we're an alternative credit manager, been going about 37 years now, 16 billion AUM. As of 2 years ago, we became part of the private alternatives business of AllianceBernstein, so kind of a bigger generic asset manager, 800 billion or so AUM. Unsurprisingly, kind of given this panel, my sort of investment mandate and area of focus is asset-based finance, or specialty finance, we also call it. I've been with the business about 8 years now, and kind of UK and pan-European mandate. Maybe the only other point I would make is kind of, as I think this panel demonstrates, there's very much kind of an acceleration and kind of new interest in the ABF space. For us in Carval, it's a sector we've really been investing in since GFC, so 15 years or so now. So for us, it's kind of not a new space.
It is fun when people discover it, though. They're
It
like,
is fun.
asset-backed finance. Like, yeah, it's been going for decades.
Exactly.
We're still here.
Afternoon all. My name is Gandharp. I run SpecFin Capital. We're an advisory boutique based out of London. We specialize in capital solutions for the specialty finance sector that covers both originators as well as solutions for loan portfolios. I guess that gives us the fortunate ringside view of a rapidly evolving specialty finance landscape across all of Europe, if not also globally. We have the pleasure of working on all sorts of interesting mandates covering all pieces of the cap structure, senior, mezz, junior, retention financings, opco, leverage, and anything and everything in between. And as a result, I guess get to interact with a lot of people on this panel in various capacities. But yeah, hoping the next 46 minutes go faster than the last two. But Patricia, on to you.
Hello, my name is Patrizia Lando, and I head capital market at Fasanara Capital. Fasanara is an alternative asset manager set up 12 years ago, based in London, regulated with Luxembourg-based funds. We manage 4 billion of assets. Our capital is insurance companies, sovereign wealth fund, European banks, as well as Asian and North American pension funds. We deploy capital in the format of asset-based lending as well as venture capital. The way we operate is that we have a broad mandate. We can do senior, stretch senior, mezzanine, equity, and whole loan, just like everyone else. But we are relatively restricted in terms of duration. So we tend to prefer short-dated assets. And the whole focus is granularity in order to provide our investors stability of return. Therefore, we tend to have investments in very small tickets in the consumer and SME space.
Good morning, everyone. I'm Luis Diurco, CEO of Novicap. Novicap is a fintech with a 10-year track record in building technology to originate, underwrite, and service working capital facilities with a focus on the SME market. That credit part of the business, we fund it with forward flow agreements with institutional investors like, for example, Fasanara.
Great. So before we lead into the panel, I guess we're really here to focus today on asset-based finance, and it is not new. It is a $25+ trillion market. I think what's new is that we're seeing a structural shift, like we did post the GFC, where direct lending, which was traditional private credit, we're seeing that private credit expand into asset-based finance, and that rise of direct lending post-GFC and stepping in for that gap in the market due to the impact and the regulation that came after the financial crisis, seeing something similar in the asset-based finance space today, post-regional bank crisis and the impending regulation that's coming. And really just that shift in the ecosystem of where banks play and private capital entering the space. And we talked a lot about, or Joel talked a lot about that in the keynote, about partnerships with banks. And we are here to partner with banks, not compete. It really is just a shift of the risk and the origination, the risk, the back leverage, all of those things still exist in this market, but it is a shift, just a shift of the positioning in the ecosystem. So we're going to explore that a bit today. What are the dynamics, the market dynamics playing into the space? What's attracting so much capital into the space? What are the opportunities? What are the challenges? And then we can dig in a little bit into things like fund finance, which we just heard from Richard and Seth talk a lot about how that's becoming a big aspect of private credit and the asset-based finance space. So without further ado, we'll start off by getting some feedback from you all on how sponsors are positioning asset-based finance to their LPs, and how has the appetite for asset-based finance evolved in recent years? Let's start with Eli.
Sure. So I think, as you've gathered from the introductions, a lot of people on this panel and a lot of people in the audience have been doing asset-backed and asset-backed investing, asset-backed finance. The moniker may have changed, but the underlying loans that people are making haven't changed for many, many decades. And people used to make securitization markets of businesses that no longer exist, called GE Capital, NCIT, and many prop desks at banks. Eventually there was a diaspora and everyone left and started smaller institutions, and now we're in this cycle where there's a bit of a consolidation with larger players essentially reconstituting the businesses that we all used to be in many years ago, but doing it in a private context without relying on short-term liabilities. And I think if we've learned one thing, hopefully, it's that a material mismatch between assets and liabilities long-term is not a great thing. So the asset class has always been there, but we have seen a material increase in, say, public coverage as well as interest from long-term institutional investors as to how to get access to this. And I remember it was not so very long ago sitting in front of LPs and trying to explain that asset-backed investing is different from traditional corporate credit risk, and that actually it makes sense to have both because they're good complementary asset classes that are not necessarily particularly correlated and both quite scalable and so on. So we're delighted to see the increased interest from institutional investors to get access to this risk, and we think that's a long-term shift, but we haven't had to change the way we operate in order to deliver the risks and returns that we've been delivering. So we haven't had to change the pitch because the pitch is the same. These are granular, self-liquidating, amortizing portfolios. It makes it very difficult to lose money when people are constantly paying you back, and delivering that at scale is kind of how we do business. The other key thing, and we think this is why scale is very helpful, is we're strong believers that it's very difficult to specialize on a single individual format or asset class in this universe. There's, if you were to, and I'm not going to pick on SRT specifically, to set up your business and exclusively invest into SRTs or any specific format or asset class, there will be a part in the cycle where that is not particularly compelling. And rest assured, if you've promised investors that that's what you're going to do, that's what you're going to do in years 1, 2, 3, 4, and 5, regardless of how rates change or how demand and supply of capital moves or how regulatory environment changes for your competitors. And I think we're firm believers that our ability to deliver the entire asset-backed universe is what gives us the ability to deliver some alpha, because at some point, some of the asset classes that we truly love will become too competitive or not interesting, and there's always something to do in the asset-backed space. It's a vast, vast universe.
Thank you. Rob, do you want to weigh in with how your pitch to LPs and the interest that you're getting from LPs in the asset-backed space?
Yeah, I mean, to be honest, I echo a lot of what Eli just said. I mean, we've been talking to LPs about it for a long time, but there's definitely more interest now. I think there's an increasing awareness of the size of the market. Effectively, it's on a par with private equity in terms of size. It's a lot bigger than direct lending, maybe 6 times bigger, I think, on some studies we did. Again, there is increased kind of awareness and acceptance of the benefits of it as a diversifier versus corporate direct lending. Again, as you said, granular amortizing cash flows, lower beta, lower cross-market correlation, structural protections, alignment with the originator, kind of it comps very well versus, say, a traditional corporate direct lending exposure. You might have a bullet loan, repayment is not amortizing, it's contingent on a refi event or a sale event for the business. You've got higher beta, higher market risk, higher idiosyncratic risk on that business. You've probably got cover-like documentation, that kind of profile. So on a relative value basis, it comps very well. And maybe I guess the other factor behind the increased publicity and the increased interest has been some of the kind of acceleration we've seen recently in the sort of longer term bank retrenchment sort of trend, disintermediation from certain asset classes, just that retreat to the kind of core banking products, high street products, and so on. And so you had Dodd-Frank and CRD, etc. post GFC, but more recently you've got Basel III Endgame or Basel IV as it's called in some places. So higher RWA, output floors on IRB models. Obviously hits the book. U.S. banking crisis, CRE values down, rates increases. Tightening lending criteria, just that general pullback by the banks, and kind of the increasing space for specialised lenders to step in has definitely accelerated in the last couple of years. And LPs are obviously seeing that and responding well to it when you pitch the product.
One thing I'd like to add to that, the way that we pitch the product is focusing on the short-term asset duration. Because especially what we've seen over the last couple of years is that with increasing rates, we've been able to reprice as quickly as possible, thanks to the short duration and the high granularity. Also, as the market changed and we've seen a recessionary environment, we've been able to assess very quickly what works and what doesn't work, and therefore repivoted the fund strategies across various asset classes or jurisdictions, for what matter, in order to be able to continue to navigate through that phase and maintain the same level of yield.
Just a quick observation, probably, I guess, sitting outside of the GP, LP world, looking at this sort of market perspective, I guess the end result of a lot of conversation and activity in that space is perhaps 10, 15 years ago, you would have, with a lot of credit and bond fund managers, you would have a little sidecar which would do potentially illiquid private for asset-backed. And now it's entire funds being raised as a result, specifically for these types of assets. And that's successfully done by practically every fund manager on this panel here and lots of others in the market. I think that definitely points to a secular trend in that direction, and definitely a LP universe education effort across the industry, where they can see the diversification benefit, they can see the non-correlation versus other credit and the stability and the non-volatility of mark-to-markets that you'd be subjected to for other forms. So I think the end result is very much visible for people who are dealing with these funds on the other side, that there's very much specialized capital now specifically for this purpose successfully being raised at scale.
Nothing like a little shock to the system to remind people that asset-backed makes sense, right?
And also seeing further development in that publicly rated, privately rated, and then unrated or more illiquid, as the sector is developing even further as private capital steps in. it'll be interesting to see how that develops going forward. Do any of you think that the dynamic changes from with LPs and raising funds for this jurisdictionally? So U.S. versus Europe versus other. Do any of those dynamics change, or is this really just a global trend and the money's coming in globally from the LPs?
Look, I'll speak for Ares. We're a developed markets investor, right? So we invest in North America, Europe, and Australia and New Zealand. We're very active across all three of those markets. So in terms of where we're deploying capital, what do you need to be able to do asset-backed investing? You need good regulatory environment, the rule of law, a security structure that's enforceable and works, and the ability to get your money back if things don't work out. That's really only possible in a reasonably small number of jurisdictions. And let's call most of the EU as a single one. It's not 50 places in the world that you can do this, but the demand from the investor base is overwhelmingly global, right? I think we know that well. We have investors from every part of the world that want to get exposure to this asset class. So it's not particularly a North American or a European effect. I think it's fairly universal. We have investors from Asia and from Australia and from North America and Europe and everywhere else.
Thank you.
I think maybe the one thing I would add on the sort of North America versus Europe dynamic is obviously US particularly, but North America, very deep market, very homogenous, good data, very deep capital markets. Things tend to price a little bit tighter on average, we think. Europe, obviously a lot more heterogeneous in terms of local jurisdictions, local debtor behavior, legal systems, data quality, data depth, data history, and just dynamics are different. So with that sort of fragmentation and heterogeneity, can't say that word, we do find sometimes you can get a little bit more value in things on average price a little bit wider. There are pockets of which are more interesting, but it's hard work. It needs to be bottom up. You need to know what you're doing on the ground and so on. So it's kind of, horses for courses, but there is a little bit of, geographical relative value kind of differentiation that we see and we talk about a lot.
That makes sense. Let's take it over to Lois to speak a little bit about how the real economy demand for this financing has evolved and some of the dynamics associated with that in financing the sector.
Sure. I think what's really interesting is the timing element of the recent rise in ABF from LPs and from managers, because it comes at the same time as we've seen a sort of acceleration within the real economy of the retrenchment of banks. And I'm talking specifically for Europe. And that's a factor as regulation, like Rob said, but also consolidation. The number of banks in Europe has been shrinking massively. So when you look at the SME landscape, they're in desperate need for an alternative solution. Not something to entirely substitute, but something to complement. So the real economy needs a well-functioning ABF market, and this recent rise in interest is very good in timing. Now, from our perspective, what we see the challenge for fund managers is how do they, given that it's not scalable and costly to originate directly, how do you partner with the right originators? And therefore, the most agile funds that understand, depending on which sub-asset class that they're looking at, how they can convert the traditional public ABF mindset, and that can be a bit straitjacket, into something that fits the need of the real economy and SMEs. I think this is the key challenge. And then finally, for us as originators, is how do we turn client products, so what we sell to SMEs, into investment products that work for these fund managers and obviously the LPs.
No, and if I can add to that, because serving the real economy is at the heart of what we do at Fasana. We pitch our LPs an investment pathway to be able to create real value to the real economy by providing capital to platforms like the one of Lois, and in turn allowing SMA to grow and distribute the wealth. What we do say to our LPs is that the investors that are keen on serving that asset class and in that space need to be patient. We don't want speculative investment partners. What we want are patient investors with stable return and that with short-term duration allows to repricing of the assets. Having said that, there is only so much repricing that is sustainable to the market. Alternatively, you either extend the maturity of the repayment and therefore place a bet on what's going to happen far down the line. But if you are actually focusing on the short term, there is the repricing, which is gentle, but LPs cannot assume that with increased rates, they will get the same level of return as in the past. The benchmark has changed, and in order to ensure quality of a book, the repricing is slow, and it's looking at creating partnerships with the real economy so that there is the expansion of the product base that platform like Novicap can do, serving more and more the SME with a different type of innovative products.
Maybe another point to add here, I think observing sort of evolution over the last 15, 20 years, I think what's very obvious is that fintechs and the technology that they bring have brought about the kind of efficiencies and scale at a very rapid pace, which has enabled this sort of credit to have an efficient distribution mechanic to be able to reach that real economy. I think if you think about sort of appetite, whether it's through banks or otherwise, whether there's been appetite for the credit, that's always been the case practically, whether it's bank or non-bank, institutional investors have had appetite for exposure to such asset class, but in many ways the asset class didn't exist in that kind of quantum as it exists now, and that I think is a testament to how well fintechs across both US and Europe have managed to scale and deliver, and actually deliver assets which are of bank or comparable quality, which are obviously then later in some cases publicly securitized as well. But I think without that sort of distribution network of what fintechs have delivered, I think that wouldn't have been possible. So I think certainly on the unsecured SME consumer and also in bits of the mortgage space, we see a real sort of transformation in the last 10, 15 years enabled by technology, which allows certain business models to exist which wouldn't have otherwise been possible if you were doing it in a big bank. So, yeah.
And to build on that, I think it's also grown the specialty finance universe itself. You know, there are new acquisition channels, embedded finance, some new kind of e-commerce point of sale, all this kind of thing. There are new channels to originate credit, and you know, with improvements in tech, AI, machine learning, open banking, all this kind of stuff, it expands the universe of customers you can responsibly but also profitably lend to. So it's just kind of grown the market. And again, to your point, Kendall, I think banks are less well positioned to do that. You know, a typical bank IT system is a patchwork quilt of legacy systems, some even from the 80s type thing. So it's a very cumbersome thing to adapt to new technology and new systems. Obviously, fintechs are more agile. So just again, kind of another reason why you sort of see you know, the shift towards non-bank lenders in that space.
Yeah, I think the point is maturation, right? I think if you're a financial services, if you're a lending business and a non-bank lender and you've survived the gauntlet over the last 3 years and have actually reached profitability, I know it's sometimes a bad word for fintechs, but some of them are actually succeeding in accomplishing this. They're reaching critical mass and scale, and sometimes the capital that they need comes in different formats. There's, you know, sometimes people are only able to access it in securitization format or in bond format or in loan format or in equity format. So the best way to get exposure to the asset-backed universe or to those underlying portfolios may not always be in the public securitization format. And I think we're finally seeing an environment where people are able to originate enough of this risk where all of these different formats of risk actually make sense for investors like the people around this table and for investors like ourselves. So I think especially true in Europe. I mean, Europe is one of the things that makes it more interesting and exciting to work here is I go to the US and I'll meet a guy who works at a real estate firm and his entire job is to sell like Walgreens and CVS's in the upper Northeast. And I'll say that's not a fun pastime, but like that's not a job in Europe. You have to be broader mandated. You have to be a generalist a little bit and pivot from jurisdiction to jurisdiction and some asset class to some asset class, and occasionally when appropriate from different formats to other formats. And it's exciting to see that the market is now sufficiently buoyant and there's sufficiently profitable businesses to partner with to be able to deliver that kind of scale.
So let's shift it back from non-bank lenders to the banks and talk a little bit about what they need. I personally spend a lot of time listening, really listening to the banks and speaking a lot to those teams that are either getting formed or are already formed and are working on optimizing the balance sheet for banks, especially in the wake of regulatory changes that are coming. So I'd like to dive a little bit deeper into what they need. We hear a lot about lately partnerships with private capital, forward flows, SRTs is obviously a hot topic, but maybe we can discuss a little bit about diving in deeper a little bit into what the banks need and how our capital can partner with them.
Hey, look, I strongly believe in this symbiosis between regulated deposit-taking institutions and non-regulated private institutions, like a lot of the people on this panel. There's no scenario where we expect the banks to disappear from the ecosystem. They may hold less risk, as they are clearly going to do going forward, but they're still critical to the functioning of the asset-backed universe. And we interact with them in three ways. We borrow from them when appropriate. Obviously, the assets that we finance or buy are occasionally leverageable when appropriate. We take, in investment-grade AAA financing from deposit-taking institutions. That makes perfect sense for the client and for us. We buy risk from them when it makes sense to buy risk in various formats. And we also provide solutions to clients of the bank that may not have a DCM or ECM or bank capital solution. And there's actually, especially in a dislocated capital market environment like today, there's a large number of businesses in the TMT space, in the real estate space, in the financial services space that need structured solutions, maybe in the form of a convertible pref or structured equity or a perpetual bond or a variety of different instruments. And maybe a bank is not the best set up to currently distribute and originate that risk. But going forward, there needs to be a partnership between private investors and the people who are the first guy to get called by a large listed business. It's despite the enormous size of Ares at 450 billion or whatever it is today, and our size of 40 plus billion, we're still not going to be as big as JP Morgan, nor are we supposed to be. But we do need to have a symbiotic partnership with them to provide those non-bank balance sheet solutions. So that's I think that's never going away.
And to that last point, it's often very kind of symbiotic, and it helps both sides. The bank can typically, we're having a lot of these conversations ourselves, and there's real traction now. The bank wants to keep the customer, they want to front that relationship, they want to cross-sell other products, but the specific product in question that the customer needs, it's RWA density is too high, it doesn't work for the balance sheet, ROE is not good enough, whatever. So can you do some kind of back-ended capital solution there that helps them out but lets them keep the customer, and you've got that as a symbiotic relationship and a good acquisition channel to that credit, but you're not sort of trying to disintermediate them from their customer.
This is a fee business, remember? The banks are in the fee business. We are in the credit business. So the way we make money is perfectly complementary.
Yeah.
And the best partnerships are the ones where the banks want to continue originating the products and we want to continue holding the risk on those products. And there's a variety of ways that we can do that, but there's no desire for us to sell them, kind of hedging products or treasury or any of the other many ways in which they make profits.
Patrizia, do you want to comment on how you're sourcing your opportunities, how you're financing them in the market? And
Yeah, so we're based in London and we operate across 60 jurisdictions by creating partnership with local platform originators such as Novica. We have a very strong sourcing team. Remember, we've been around to do this type of business for 12 years, specializing first in a short-term SME risk and then expand in the product base. So we've made a name for ourselves that has enabled us to trade at this stage 65 billion of assets. And what we do is we tend to focus on the fintech early stage lender or the platform economy and the embedded finance platforms. We have 200 employees, of which 120 are tech and data scientists. So for us, of paramount importance. It's not just to deploy the capital, it's to ensure that we integrate the system with the various partners. So we have a spoke and hub approach across various partnerships. And we ensure that because it's a very early stage, that we are able to start working with them, providing them with senior and then growing the relationship and moving to a stretch senior and so on. And we're not afraid to start very small. We're able to ensure that we create a long-term relationship with these, let's say, spokes or platforms, and we integrate the technology that they have with our own, and there is a constant exchange of data. We think of ourselves also as a technology company. This interaction of data allows us to create more detailed and more intelligent underwriting in those asset classes and risk management. So that's the way that we source our capital. And Novicap has been very generous and one of the best platforms that we've been working with since 2017. We've also invested in the equity of the platform and working seamlessly with the exchange of data and technology.
So maybe we can put that to Lois then. Given it's a different seat in the ecosystem, you could talk a little bit about your partnerships and how you're sourcing your opportunities, and then moving on to how you source your partners to meet the opportunity set that you see.
So I think there's been a big change over the past 2 years with respect to commercial banks. Commercial banks used to see originators like us as a threat, as a competitor, but they've realized by now that typically if they can offer what the client needs, they will win because they're cheaper, unfortunately. And so the big change has been now they're in the mindset to work with us. So in our case, for example, in Spain, we've been signing up partnerships with commercial banks where they send us existing clients where there are some needs that they cannot attend to. It can be about risk limits, it can be the type of products, and so on and so on. And for us, this is the key channel, the key origination channel, strategic partnerships, because we believe it's scalable, it externalizes a lot of costs for us, and also it brings some sort of positive risk selection. So this is how we go about sourcing opportunities and making sure we have a scalable origination platform.
It's all about partnerships. Kendra, maybe we'll go to you next with any thoughts on any areas where you're seeing the most significant opportunities, in your opinion.
I think maybe zooming out a little bit in terms of what we probably see as like strong secular long-term trends. I think we do see maybe over the last 20 odd years, maybe looking at the US market, the biggest one to begin with, consolidation within generally the bank sector. And I think at some point the stat I was given was there used to be 8,000 FDIC insured deposit takers in the US. Now there are about 4,000, and that's going to probably continue to be shrinking even further. That means certain banks end up being very, very big balance sheets, but also certain banks just end up effectively deleveraging or selling assets and just reducing or shrinking balance sheets, and effectively end up being more origination as a service type proposition, a bit like what I think Eli tried to cover earlier as well, where many of these long-term cash flows and long-term assets are better matched by private capital, which is long-term capital, as opposed to with deposits. I think we will continue probably to see that kind of trend. We also, I guess, interestingly, when we talk about sourcing of this kind of these kind of granular assets, we actually do, at least for the last 5-7 years, see an increasing trend where fund managers will also sort of vertically integrate in the sense of not just buying and funding assets, but also wanting to own the platforms, a bit like, I guess, your equity stake in this particular one, but also, I mean, to my right, CarVal have been owners of multiple origination platforms, mortgage origination platforms across different jurisdictions. Probably same applies for a whole other set of credit funds and PE funds, which are eventually interested in the assets, but the best way to sort of lock in a partnership is to effectively set up one of these or buy into one of these. So we see that kind of trend prevail for at least really pick up in the last 5-7 years a lot more. And I guess that obviously gives you long-term exposure and sort of your own origination engine. We also, I guess, in the UK, quite specifically see a lot of insurance companies buying their own origination platforms, specifically for the assets that are very attractive for them, equity release and the likes, which practically multiple big insurers have bought into. So I think people sourcing assets creatively, either through bank partnerships or being able to buy into platforms, I guess we see that as a continuing trend around the origination of these types of private assets.
Eli, do you want to comment on what you think? What do you have most conviction on right now, or any significant opportunities that you see in the asset-based finance market?
Sure. Well, I want to echo the platform and bank partnership thing. I think we touched on it earlier. That's a clear trend, and I think we have partnerships with north of 20 platforms in order to ensure that we have access to the types of products that we want. Look, the reality is what's interesting and what's not interesting, and especially when you have a very broad remit like we're privileged to do, you have to form views as to what's going to be in focus and what's not. And that's driven overwhelmingly by 2 or 3 things, kind of rates, demand and supply of capital in that space, and the regulatory environment, how it affects deposit-taking institutions being active or inactive in it. One example of an asset class that we haven't talked about much that we're very active in is TMT. I think it's publicly announced we've invested into a few data center portfolios recently. We did one with Vantage recently. We did another one last year with EdgeConneX. It's an example of an asset class where there's a material dislocation. Essentially, there's not enough money to go around, despite the fact that there's quite a bit of common equity being raised and quite a robust bank appetite to provide the senior lending. We're finding a lot of opportunities up and down the capital structure, not just in data centers, but across the TMT sector, just because of the enormous amount of growth that's required in that space. Now we're going to start to see other constraints such as energy, and there's some ESG concerns and concentration. So it's you have to know what you're doing. But we like that sector quite a lot, and we think that we're going to continue to see opportunities to invest, whether it's senior secured debt, subordinated debt, or structured equity in the sector. So yeah, we think that's an interesting one. And then we've touched on it a few times already, but providing solutions to GPs in various formats, whether it's NAV lending or loans to GPs in debt or an equity format. And look, that's being driven really by the rates environment and a massive dislocation in valuations. So assets where there's a disconnect between where the market believes the assets should be priced and where the assets are held, to the extent that you have a discrepancy that creates an enormous disincentive to liquidate those assets in the open market. And it also creates an opportunity for us and others to provide essentially an option value instrument to the owner of that asset to see what it's worth in 2025, 2026, 2027, at some point in the future when hopefully rates are more accommodating, valuations are a little bit less punitive. And we're happy to take the other side of that trade when appropriate because we can pick and choose where we play. The underlying assets, obviously private equity assets come into focus because they're very highly valued despite whatever may or may not be happening in the public markets. And you can tell the same is true with real estate. You can look at capital markets exposure, and if you're a REIT and you've got bonds out and those bonds are trading at an implied yield, that probably shows your mark is wrong. If you're trading at a material discount to NAV because your REIT is listed, it probably shows that either the market is wrong or your mark is wrong. If you're an asset manager and your secondary stake is trading at 30 cents discount, probably means that there's a disconnect between where they're marked and where they're valued. The reality is both are a little bit wrong, and they'll normalize over time. But during that period of dislocation, that's when these structured instruments make the most sense. So I'd say solutions for various asset managers in various formats is another big one.
On the topic of data centers then, there has to be an obligatory question on AI, which I'm going to direct at Patrizia. Talk to us about AI and deploying it, and then more generally, what do you see technological advances driving? How are they driving the growth of ABF?
So I think it was even said earlier this morning, I think AI is a fundamental tool to improve efficiency. We utilize AI to support our underwriting, but by no means is the only tool, and we use it as benchmark. We're able to do that because we are constantly able to refresh the model because we have very short assets. So we have an immediate response on the validity of the tool because we don't need to wait down the line, the results of our prediction. We're able to see that in immediate format and then amend it and adjust our model accordingly. So in the SME space, we have our own credit scoring that constantly get validated and benchmarked with the results of what we have on the modeling and the machine learning. So I would say that AI is a phenomenal tool. We're a very long way to have any type of asset class relying on this tool on its own. The human and expertise, the human impact, it's definitely what will continue to drive the decision making. And AI, it's just a support tool for more routine tasks or improvements for efficiencies with regards to the decision making.
I'm waiting for ChatGPT underwrote this portfolio disclaimer in the LP pitching documents.
Yeah.
Hopefully not yet.
No.
Just on the topic, I guess, slightly inverting the question, I think what would be very interesting and maybe will be a topic maybe 2-3 years from now in panels will probably be how private credit is actually enabling AI in the sense if data and storage and compute is going to be the new oil, are banks going to be the best place to finance that kind of expenditure? And that's going to be at both B2B and B2C levels of businesses needing compute, people needing compute, and eventually needing to pay that and needing some way of financing that in an efficient way. I think that'll probably be the future of potentially new asset classes within private credit and probably goes a bit beyond just the data centers. And I can imagine, Eli, you'll probably be very busy funding those as and when they evolve.
Got to put those cat videos somewhere, right?
Yeah.
Maybe before we go to questions, we'll do one more broader question for everyone to answer. Where does asset-based finance go from here? We'll start with Lois down at the end and work our way backwards.
So I think if you look at the history of the asset class for the past decade, it's been a story of how can we access more and more niches that were not accessible before via technology. And what you just talked about, we're still at the very, very early stages of that. And so if you couple that with the multi-decade trend that we spoke about of bank retrenchment, especially in Europe where the banks are still 85% of SME lending, I think we have a very, very long landscape of opportunities ahead of us from there.
Thank you.
From my side, I come from banking and I worked a lot on distressed assets, non-performing loan, and I kept seeing the same products for a very long time, which were originated by the banks. Then I joined Fasanara 3 years ago, and I learned about buy now pay later, embedded financing, things that I didn't even know before. And I am confronted every day with innovators and technology experts which come up with new products constantly. Embedded finance has been a game changer because you can create a financial products at the checkout of every single sale. So the customer experience has changed, whereby, my father still goes to the bank branch and only invests with a certain individual, and if he moves, he will move his money there. That doesn't happen anymore. So on one side, it has made the market expanded. It has also made the market a little bit more vulnerable because this checkout can be with you today and with somebody else tomorrow. It's an unregulated, and it has been tested through the recent COVID and recent financial crisis, but is still virtually unregulated. So I think the growth of that it's phenomenal, and we should all be looking at the new products that are coming out, which could be financed with the asset-based lending. At the same time, keep an eye on the regulators because it will be coming. I mean, it's an unfair playing field at the moment. And so we as funds are regulated, and we need to ensure that the platforms we work with and the embedded funds are regulated, and they use the data in an appropriate way. So the market is expanding, but things are along the way, and it will really depend on the speed of the regulators, on making sure that there is a little bit more rigor into this growth.
Maybe two different ways of looking at the future. One would be, I guess, on the origination distribution side, where I think echoing probably views of others on this panel as well, which is with tech innovation, whether it's fintechs and or banks, eventually there will be more innovative financial products offered, stuff which was not around 10 years ago and is eventually still consumer or SME, but the way in which it's packaged and delivered and distributed to the end borrower or obligor, we will continue to see innovations in the coming years, enabled by the technology. I guess the other side, which is on the institutional capital and funding side, I think it's fair to say that all trends point towards, I think one of the stats I read was 5 trillion for ABF private credit right now, and expected to be about 7.7 in the next 5, which is about a 50%, close to 50% growth. So I think you should expect that comes with a degree of more sophistication of structures, but also more homogenization, standardization of structures. Right now we see almost every new facility or funding done in a very bespoke way. I think more of that will start to become more market standard, a bit more almost like an LMA for these type of bespoke asset classes as and when they reach maturation. So I think those are probably the easy, predictable.
Makes sense. Rob?
Not that much more to say. I mean, look, the trends that have been discussed on this panel are secular and enduring. The asset class will continue to grow. I think I read a study saying it would get to 10 trillion by 2028. So, it's definitely going to grow. Exciting times. I mean, I think maybe we sort of see ABF in a similar spot to where sort of corporate direct lending was maybe a decade ago. Right before there was this huge kind of shift in non-IG corporate credit, away from the banks to private capital managers. And yeah, look, I think it will just continue in the same way for ABF. Good for us.
Yeah, we're in the early innings. That's clear. I think I agree with that.
Okay. Why don't we look at some of the questions that we've gotten from the audience here? Maybe someone can comment about pitching asset-based finance in Europe and any regulatory hurdles. Are you facing regulatory hurdles in sourcing the assets for European LPs? I don't know if Eli or Rob have any comment on that.
Yeah, look, so different LPs have different constraints. There are tax constraints, there are regulatory constraints, and so on. We operate a variety of different vehicles. They work for most of the investors that we try to address. I don't want to comment specifically on how some regulations affect some LPs, but we work with them to structure solutions that work at the end of the day for our clients, who are the people that give us the money. So I would say it's definitely a consideration, but it's not something that's kind of affected our ability to be relevant.
Yeah. I wouldn't say EU SecReg in particular has caused any problems for LPs or our investment structures. Often private fundings, constitute securitizations anyway and are structured accordingly, but nothing really else to say on it.
Okay. Do we think the growth in private credit via securitization requires public or private ratings?
So I think this is a question about the rise of insurance in asset-backed investing, right? So, and it's a question of obviously U.S. and European insurance, as I think Joel touched on the other panel, of completely different methodologies for how they allocate risk. Now, the reality is U.S. insurance companies are quite active in asset-backed finance globally. Usually that requires a rating methodology that is one source of capital. A lot of the people that are investing this, including Ares, covers both various forms of capital, both rated and unrated. We see it as a continuum of risk return. And if we find a great return that happens to be investment grade, then we have an investment grade source of capital for it. Some of these things are not necessarily investment grade in terms of their risk, therefore no rating is appropriate or necessary. So ratings is just a methodology to format something into a format that is compliant for certain liability matching. It's not an indication of risk. Now, if you want to access the public markets, as the public markets tend to develop, yes, more ratings will be required. But I think we spent a lot of time thinking about them because there's a rise of insurance, but it's nothing particularly unusual.
And I guess coming with the rise of insurance, you really need, as private credit investors, we pitch that we are bringing complete solutions. And so insurance is part of that solution. And yes, that needs to be rated, but I think we really have to bring the whole solution. You have to be able to offer, okay, well, a rated piece can go here, but here's where the rest of it can go into the various unrated pockets or illiquid pockets of capital. So really having that continuum and having that capital to support that continuum, I think is key. So as one gets bigger, the other's going to need to get bigger.
Yeah, running just a rated product is, we think, strategically quite limiting, in the same way that only investing in a specific format is incredibly limiting, and I would argue long-term actually rather dangerous. So yeah, the market will continue to develop across both rated and unrated, and I think the investors here will develop in the same way.
We have flashing red lights, so I think we're getting kicked off. So we'll wrap it up there, and thank you everyone for joining, and thank you to the panelists.
Cool.
Bravo.